Welcome back to 20 Minutes of Clarity.
Time to start talking about that often overlooked but absolutely essential for maintaining a healthy portfolio. Rebalancing. Very sexy. It's not just a financial buzzword, right? It's a powerful tool to ensure your investments stay aligned within your overall financial goals, whether you're focusing on growth or preparing for retirement or managing liquidity needs. Today, we're diving into why rebalancing is essential to help you avoid, risk and optimize overall performance and meet your overall financial objectives. Now, Andy, as we were preparing, you said, let's talk about rebalancing. I'm like, okay, let's just like, we got to make this entertaining, my goodness gracious. But I also think it's good for us to just define what it is, because we have listeners that come from all different backgrounds. So how would you describe rebalancing for the person who's just getting started so that they understand the concept of what we're discussing?
Yeah, I think the simple definition is it's more than just tweaking investments. It's really about aligning, your personal investment or your investable assets with your personal goals, the current changes of the market, and then also your financial needs are really the big three. That's why you do it, and that's what it is. But it's really the act of changing your current investment strategy for the purpose of, whatever's going on in your life. It's a simple.
You said it's beyond just making those tweaks and adjustments. I'm looking at a couple of things as a professional when I'm looking to make a rebalance. And I'm looking at not just like what's the drift of a portfolio, and I'll explain that here in a moment, but also did financial objectives change? Is there a major life event coming around the corner that I need to prepare for, like retirement, for instance, right? Things of that nature. And then we talked about in prior podcasts, so I'm not going to go too deep on this one, Andy, but what is the risk capacity of the overall financial plan? Risk capacity comes into this conversation quite a bit on when to rebalance and how to rebalance. As far as drift, best when I describe this is a great story. This happened in, I want to say around 2015. This person came into the office. It was the first time we're meeting, and she's retired for the last 10 years, and she had 90% of her money invested in stocks, 10% in bonds. And that is a very high risk profile, just to look at it as in a standard. And I said, hey, just out of curiosity, how did you come to get this mixture of stocks and bonds? And she said, I didn't do that. When I left to take care of my mom for the last 10 years, I had 50% of my money in stocks and 50% in bonds. I have no idea how it got to 90-10. And I was explaining to her, like I'm explaining to our listeners now, well, the stock market way outperformed the bond market for that 10-year period of time. In fact, it was an amazing 10-year period of time in the stock market, right? Over that 10 years. You had some pullback, obviously, like in 2008, but you had 50-50, so you didn't go down as much. But the stock market just ran, and you got to run with it. And that's why it's now 90%. So she did not rebalance. And then it drifted way above her risk capacity of her financial plan, way above her risk tolerance, how she felt about risk. Now, this is a happy surprise for her, but it could have been a very bad surprise if we kept that and the market pulled back like it did in 2018, 2020, 2022, right? Right? And if we kept it that, then she could have been betrayed by the market because it would have taken it back because she didn't ever rebalance. She allowed the portfolio to drift. So do you see how it just goes beyond just drift? It goes into where she was in her stage of life. She's now in retirement. Now, she did get a federal pension, so she could have. That's why she wasn't tapping into the portfolio too often, right? But what if she didn't have that pension? What if she didn't start Social Security? There's so many things that come in to this conversation, but portfolio rebalancing is the essence of managing what does your risk to return look like, coupled with what is your liquidity. Now, we throw around these terms all the time, Andy, because you and I just are in the industry, but liquidity being access to money, how quickly can you get access? How does rebalancing come into play when it comes to liquidity?
Well, I mean, I'm going to take a small step back as I answer that question, because I want people to understand why we pick this topic during this time of the year. And I think many people are probably at home right now, cleaning out, doing their spring refresh and their spring cleaning. And that's what I want you to relate to as we talk to these topics. This is about decluttering, some of the built up clutter inside your investment portfolios, just like you do your home. Maybe you've changed some of your game planning around the house and you want to do add a new addition or do a home improvement project, just like you might change your income strategies. And as Jason just asked there, the point of all this is by having everything in the proper place, you're able to be more proactive in how you would be able to handle changes throughout your financial life during the next short-term market cycle. So the biggest thing in a portfolio, though, is understanding how the liquidity of that portfolio is. That's the big thing I review. I think liquidity is the top thing that we should be reviewing. I mean, obviously equities and fixed asset allocation is important for people to understand, like, okay, did my equity increase from my baseline? Did it drop? Whatever it may have been, which is important to know. But I think people need to be able to look at it and say, how liquid, how breathable is my portfolio in the event that I needed a life change or a life event? So I think that's the most important part about rebalancing, is just making sure that our clients understand if an event came up, are they liquid enough to do so? And part of that is just by running a simple investment analysis based on their current spring cleaning objectives within their portfolio.
Yeah, like life events such as like college tuition, buying a home, unexpected emergencies, they all require liquidity. And to make sure you have enough in cash or liquid assets available when you need them without having to sell investments at a time during an unfavorable market, right? And we go into a market pullback, you're not looking at selling positions in a down market, right? So what other avenues of assets do you have that are liquid that you could get access to comes into the analysis, comes into this consideration, especially when we're analyzing a rebalancing or readjustments within a strategy, within an approach.
Yeah, it may be also about rebalancing to raise additional cash for liquidity, right? And so if you don't know what your liquidity needs for the next 6 months are, part of rebalancing is to ensure that you have the proper cash so that you're not stuck with what you mentioned earlier, Jason, of having to sell in a down market or an unopportune time or the unideal time in the market to generate that liquidity. So I think that's the key, is refreshing some of that cash flow for liquidity. I think is really, really important.
I'm just going to talk about the industry for a moment here. What I found early on in my career was a lot of financial advisors were using a calendar to determine when to rebalance. They put it on the first month of the quarter, every quarter. They just blocked off that Friday, and that's when they sat there and they did their trading for all the accounts to rebalance the portfolio due to the drift. That's still a common occurrence, unfortunately. I'm always looking at vetting programs, and one of the programs that I was vetting and considering for then portfolio strategies and construction says, hey, you could automate quarterly rebalancing. Okay, it's a benefit to the advisor. It's not necessarily a benefit to the client. Now, there's arguments to be made on this topic, saying like, okay, you do it quarterly, at least you're doing it consistently. Or you use what I think is harder to do, is you're looking at what is the overall drift of the portfolio, what is the liquidity needs, how does it fit into the overall financial plan, to then make that to be the decision of when to rebalance and not a calendar. It's just easy for the advisors to do it on a calendar basis. It became so industry, Andy. I'm lifting the veil for the industry right now. It became so easy, we could automate it. We don't have to spend the first Friday of that quarter anymore rebalancing all the portfolios. No, go get a tea time, block off that day instead so you can still play golf. What are we talking about? No, what I subscribe for is this program that sends me an alert when the drift analysis hits over certain variances. I go in and I got to say anecdotally, it's about 60% of the time do I make a rebalance. 40% of the time I don't. The drift analysis still fits in with the risk profile, the risk capacity, still fits in with the overall financial plan, the liquidity needs. Let's go ahead and take that a little bit more of the upside, but still put that drift analysis on. So if it pulls back, I could then make that decision. Bulls and bears make money, pigs get slaughtered, right? It's an old saying. So it's just going, hey, the large cap growth has really ran. I'll start taking profits off the top, but I expected it to run with the analysis that we get from our investment oversight committee, right? Why would I trade against that? But then there's also going in, hey, let me sell that high performing stock, locking in those gains and buying those undervalued areas that they haven't grown as much, but they still showing like maybe they're oversold, or maybe I could buy them at a discount. There's that part. Now, last thing I'm going to talk about, just this consideration of the decision is this a retirement account or is this a taxable account? Because if I try to do this in a retirement account, pretty easy. I don't have any tax implications on the rebalancing. But I go to rebalance a taxable account that has short-term capital gains that's really popped shortly because of a few stocks, and I go to rebalance that risk profile, they could be raked over the coals on the tax drag, right? So it's how are you, I'm asking the listeners now, how are you deciding when to rebalance? Is it on a calendar because it's easy? Are you doing it because of what's happening within your own financial life, then the drift that's going on within a portfolio? How do you do that in a qualified account versus a non-qualified, like a taxable account? How does all this play in, right? That's what we're answering, but how are you doing it today? And if you're just saying, I just do it on the first Friday of the quarter, you're doing it old school. You're doing it like the brokers of yesteryear.
If a listener tuned in and said that they are rebalancing or know their rebalancing plan, I would be absolutely shocked because
really
probably don't.
Okay, you're saying listeners right now, okay, this is where we want you to like, subscribe, follow, share, right? But okay, great point, Andy. Are you saying that most of our listeners don't even rebalance themselves? They just let the stock that they bought that took off just go?
I mean, not to make this a bash on our industry, but let's just call it what it is. We're trying to. The point of rebalancing portfolios is to refresh it and declutter it for your future needs, right? Wherever you're headed. Too many times it's easy to rebalance a portfolio for an upcoming performance review. We've trained our clients that the way that you measure success with your financial advisor is the return they can generate. Well, when you can run reports and rebalance portfolios to own certain things, you're changing the narrative to keep a job. I mean, that's just as raw as I've ever been about it. So why would someone sit down and what you highlighted there is you're just talking about rebalancing on a systematic basis to the public market portfolio. That's where we backed it out and said it's got to be a rebalance from a holistic, a comprehensive investment level. It's got to be, how are we rebalancing your public markets? Now, I'm not against kind of having a systematic rebalance, as you entered or explained as well on the public market exposure. That's risk-based. Right, Jason, you and I talk to clients all the time. If your risk is a moderate growth or a moderate conservative, you have a different tilt in how much equities you own to how much fixed income you own, right? That can't move and deviate too much or drift, as you say. So there's two ways to do it. Systematically do it, which could be a lazier way, but a retirement account, not a problem because there's no tax decision. A more comprehensive account or a more taxable account might take more of a deeper look and have to take more of a specialized drift that you referred to. So that's step one. But then you guys start asking yourself, outside of my liquidity raise, do I feel confident in the direction of my plan? Do I need to find investments that are more protection based? Because heck, let's look at it, Jason. The markets have been happy for a while, up until the end of last year. If there's a time you got to take some of that risk off the table, so you might need to rebalance it from public and into protection-based assets, whether that's annuities or adding cash value or structured investments or more cash. And for our accredited investors, we might even have to rebalance it further and add in more private investments so that we get less correlated access to market return. And so it's a bigger picture than just what I think the traditional industry sells when it says we're going to rebalance a portfolio. That's fine. I think that's return driven in a lot of cases. It's probably inappropriate if you don't understand the type of account that you refer to, taxable versus tax deferred. And then it's about locating the proper assets in growth, protection, income, as you talk about, less correlated, because the goal is to grow your investments with the smoothest line as possible. We're not looking for big mountain cliffs and falls. So I know I rambled a bit on that one, but I want the mindset for the listeners as we're kind of midway through or 3/4 way through today's discussion is think about rebalancing as a spring clean. Don't let that drawer get too cluttered. Don't have your questions unanswered in your direction of what you want to do for the next 6 to 12 months. Your money needs to drive the direction, and you don't want to be stuck in a position where it's you're not prepared and you're over cluttered and you had industry jargon. So,
well, it's like gardening, Andy. You trim what's overgrown, and you nurture the areas that need more attention and to keep that thriving. It's like pruning, right? It's like cooking. Rebalancing is like following a recipe of your favorite dish. If you add too much salt or forgetting ingredients, the balance and the flavor is off. Right? And many people in our industry, we cook with only the public markets. There is no private. There is no protected assets. But we came to this firm, we work here because we can cook with those different ingredients to build out the overall. It's like tuning a musical instrument, Andy. Like, you ever hear an instrument played out of tune? Brutal. It's awful. Have you?
I wouldn't understand what's in tune and not in tune, so I'm not the best to ask that question.
Oh, this is where you come, right? What about maintaining a car? Like, over time, the tires wear unevenly, and alignment may go off, affecting performance. There's so many ways that we do this in our life. How about trimming a bonsai tree?
Never done that.
No, I haven't. But when I see them, so my wife likes to go to like these gardens and stuff, right? And I love seeing the bonsai trees. I think it's so cool that the time, the attention, the dedication, the right pruning, and then like the wire work that they do to turn things, and how many different types of bonsai trees there. What about selling a boat? Right? Like, I was talking to one of my clients who's a pilot about this topic, about rebalancing. He has a pretty cool flight. He flies from JFK to Munich, Germany. And I was talking about the importance of minor tweaks and adjustments over time. He goes, oh my gosh, yes, we do the same thing. And I go, what if you didn't? Like, where would you land? He goes, probably somewhere in Turkey. Like, they wouldn't even land in the same country. Like, they would be totally way off. Right? And then I was reading this book, and it was talking about to send a rocket ship to the moon, they have to put a gyroscope in there, and the gyroscope stays the perfect trajectory. But the rocket ship gets reports from the gyroscope saying tilt left or tilt right. 97% of the time, it's not on course. 97% of the time. It's only 3% of the time the rocket ship is actually on the right trajectory. All that other time is making minor tweaks and adjustments. It's like the power of small tweaks and adjustments. We talked about this the last podcast. If you didn't check it out, go back and listen to it after you finish this one, of course. Right? Anyway, rebalancing a seesaw. Right? Like, if I get on a seesaw with my 10-year-old daughter, she's going to fly off. I got to keep a certain balance so she doesn't fly off, Andy.
Yeah, well,
same thing goes with portfolios. I'm getting on a tangent, so take me off the tangent and wrap up our podcast.
No, we'll wrap. That's the goal, right? Is the purpose of 20 Minutes of Clarity is to provide that everyday education. I also want to highlight real quick that as you go through this journey with us and listening to our podcast and being a loyal listener, make sure you're checking out clearpicturefinancial.com. We actually take every one of these podcasts and create white papers that have actionable steps. So it's those small steps that Jason referenced that you can do there. So as we wrap, make sure you're checking us out, tuning in to 20 Minutes of Clarity on a weekly basis, sharing it, liking it, subscribing, doing all the good stuff. But more importantly, if you're sitting at home today and the question in your head is, I don't know when the last time my portfolio was rebalanced, or I'm not sure if it meets my financial goals, that's when you reach out to us. You can go to clearpicturefinancial.com, schedule a time to meet with us, and we're happy to tell you where you're aligned, where it is. We'll do it at no cost because we believe in helping you make informed decisions that much. So make sure to tune in next week. We got another great jam-packed topic. Can't wait to talk more on more spring cleaning topics. We'll talk to you next week.
Take care.